Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. JP Morgan was founded in 1871 in New York by J. Pierpont Morgan and Anthony Drexel. The company has roots all the way back to 1799 when the Manhattan Company, its earliest predecessor, was founded. JP Morgan specializes in investment banking, asset management, private banking, private wealth management, and treasury services. JP Morgan is the largest bank stock in the Standard & Poor's 500. JP Morgan's operating segments include consumer and community banking, corporate and investment bank, commercial banking, asset and wealth management, and corporate. In 2019, the company's largest segment was consumer and community banking, which earned them $16.6 billion in revenue. Consumer and community banking has been growing the quickest for the company, as that segment's revenue grew 7% between 2018 and 2019. JP Morgan is the 13th largest company in America and is currently valued at $273 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, JP Morgan stock earned $5.29 per share. In 2015, that number jumped up 13.4% to $6 per share. In 2016, they earned $6.19 per share, a 3.2% increase from the previous year. In 2017, they earned $6.31 per share, up 1.9% from 2016. In 2018, their earnings per share jumped up to $9, which was a 42.6% increase from 2017. And in 2019, their earnings jumped up to $10.72, which was a 19.1% increase year over year. This data indicates that JP Morgan's earnings per share have grown on average 15% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of May 24th of 2020, JP Morgan was trading at $89.47 per share. This represents a 10.1 trailing 12-month price-to-earnings ratio. This price-to-earnings ratio is significantly lower than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was 21.2. This will be my 13th stock analysis video, and JP Morgan's price-to-earnings ratio is by far the lowest price-to-earnings ratio I've seen so far. Keep this information in mind for when I give my stock grades at the end of this video. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of May 24th of 2020, JP Morgan was trading at $89.47 per share. This represents a trailing 12-month price-to-earnings growth ratio of 2.22. This indicates that JP Morgan may be overvalued if this is the sole metric you use to value the company. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of May 24th of 2020, JP Morgan currently offers a dividend yield of 3.94% as they pay 90 cents per share per quarter. They most recently raised this dividend in October of 2019 when they increased it from 80 cents per share per quarter to the levels that it's at now. JP Morgan over the past 5 years has increased their dividend by an average of 15% per year. JP Morgan's dividend payout ratio is currently 10.1%, which is extremely low and indicates that they have a lot of room to grow this dividend payment in the future. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt-to-equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of March 2020, JP Morgan had a book value per share of $74.56. This represents a price-to-book ratio of 1.2. This is a pretty low price-to-book ratio compared to most of the stocks in the Standard & Poor's 500. As of April 2020, JP Morgan had a debt-to-equity ratio of 1.3. This is on the higher end of debt-to-equity ratios for stocks in the Standard & Poor's 500, but part of that is just because they are a bank stock and banks generate a lot of their money through loans and obviously have to take on quite a bit of debt in order to do so. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought JP Morgan stock on May 18th of 2017, held it for 3 years and reinvested all the dividends you received, you would have seen an average annual return of 5.3%. If you had bought JP Morgan stock on May 18th of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 9.6%. And if you had bought JP Morgan stock 10 years ago on May 18th of 2010, held it for all 10 years, and reinvested all the dividends you received, you would have seen an average annual return of 11.2%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave JP Morgan stock a B-. This was a really tough grade to give because JP Morgan is a company that tends to do well when interest rates are high and when the economy is doing really well. Currently, interest rates are really low and the economy is looking questionable at best. However, I think a lot of major bank stocks like JP Morgan learned their lesson from the 2007 financial crisis and have made preparations to ensure something like that doesn't happen again. You might have noticed that JP Morgan has a dividend payout ratio of just 10%. That to me indicates that JP Morgan is gearing up for a potential recession, and it also indicates to me that they will probably be able to withstand a recession if we do have one. As a growth investment, I gave JP Morgan a C. As I mentioned earlier, interest rates are really low right now, and we are in some uncertain economic times. So I put JP Morgan at a C. I definitely think that JP Morgan's growth will be very limited over the next couple of years, but I do think that as a long-term investment that JP Morgan still does have some growth opportunities, which is why I put them at a C and not lower than that. As for JP Morgan's value at their current price, I gave them an A. This was a very difficult decision to make, and essentially what I did is I looked at how low JP Morgan's price to earnings ratio was, I looked at how low their dividend payout ratio is, and I really think that they look like a value at this price, at least if you plan on holding them long term. I think over the short term, their stock price probably might drop a bit, but as a long-term investment, I think one day we'll look back and say, wow, why was JP Morgan trading at such a low multiple? As an overall investment, I gave JP Morgan a B. Over the next couple years, I wouldn't expect too much out of JP Morgan in terms of earnings and earnings growth, but I do think as a long-term investment, they are looking like a value right now, which is why I decided to grade them as high as I did. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.